You got a raise. Your paycheck is bigger. You should feel richer. But somehow, you don't. Your rent is higher. Your grocery bill is higher. Your car insurance is higher. A simple meal that used to cost $10 somehow costs $15. And at the end of the month, you're looking at your bank account thinking, where did all my money go? Here's the strange part. You might be making more money than you did a few years ago, while being able to afford less. So how is that possible? How can your salary go up while your financial life feels like it's going backward? And more importantly, is there anything you can actually do about it? Because for millions of Americans, getting a raise doesn't feel like getting ahead anymore. It feels like trying to run up an escalator that's moving in the opposite direction. And there are several reasons why. Let's start with the biggest one. Your raise isn't really a raise. If everything gets more expensive, imagine you earn $50,000 a year. Then your boss gives you a 10% raise. Now you're earning $55,000. That's an extra $5,000 a year. Sounds like a win. But let's look at what happens next. Your rent increases, your groceries cost more, gas costs more, your insurance premium goes up, your utility bill increases. Maybe your car needs repairs. Suddenly, that extra $5,000 doesn't feel like $5,000 anymore. It starts disappearing. And this is where people make a mistake. They look at their income, but they don't look at their purchasing power. Here's the question that really matters. How much can your money actually buy? Because earning $60,000 today doesn't automatically mean you're better off than someone earning $50,000 a few years ago. If the basic things you need have become significantly more expensive, your bigger paycheck might simply be helping you keep up. Not get ahead. Think about it. If your income goes up by $500 per month, but your essential expenses increase by $450, did your life really change? Technically, yes. You're making more money, but financially, you only have $50 more, and that's before anything unexpected happens. So let me ask you, have you ever gotten a raise and somehow still felt broke? If you have, you're not imagining it. Your income is only half of the equation. The other half is what that income can actually do for you. The biggest money vacuum, housing. Now let's talk about where a huge amount of Americans' money goes every month. Housing. Imagine getting a $400 monthly raise. You feel good. You worked for it. You earned it. Then your lease renewal arrives. Your rent is going up by $300. Just like that, 75% of your raise is gone. You haven't bought anything new. You haven't upgraded your lifestyle. You haven't gone on vacation. You're simply paying more to live in the same place. And if you own a home, the costs don't magically disappear either. There's the mortgage, property taxes, homeowners insurance, repairs, maintenance, a broken water heater, a leaking roof. Something always seems to need money. Housing is especially painful because you can't simply stop paying for it. You need somewhere to live. So when one of your biggest expenses rises, you have less room to adjust. And here's the scary question. How much of your paycheck disappears before you even get the chance to enjoy it? Rent, mortgage, utilities, insurance, debt payments. By the time many people finish paying the bills they have to pay, the month has barely started. Groceries are quietly eating your money too. Then there's food, and this one is dangerous because the increases can feel small. A few dollars more here, an extra dollar there. Your favorite product gets more expensive. The package gets smaller. You don't notice one shopping trip. But then you look at your monthly spending, and suddenly you're spending hundreds more than you remember spending before. And what are you supposed to do? Stop eating? That's what makes rising living costs so frustrating. These aren't always luxury purchases. They're necessities: food, housing, transportation, healthcare, utilities. You can't just cancel them like a subscription. So when the cost of necessities rises, people often have to take money from somewhere else. Maybe they save less. Maybe they invest less. Maybe they put more on a credit card. And this is where getting poorer can begin. Not necessarily because your income went down, but because you're building less wealth than you could have. Your paycheck isn't what you actually take home. Here's another thing. Your salary number can be misleading. Let's say your employer tells you that you now make $70,000. Great. But $70,000 isn't necessarily what arrives in your bank account. Money comes out before you see it. Taxes, Social Security, Medicare, health insurance, retirement contributions, and possibly other deductions. So when people say, I got a $10,000 raise, that doesn't mean they have an extra $10,000 to spend. The actual increase in their take-home pay can be much smaller. Then the higher cost of living gets to work, and that's when the raise starts shrinking again. First, deductions take a portion, then rent takes a portion, then food, then transportation, then insurance, then debt, then life happens. And before you know it, that raise you were excited about has vanished. So here's a question. If you got a raise tomorrow, could you tell me exactly where every extra dollar would go? If not, there's a good chance your lifestyle is about to make that decision for you. The trap nobody notices. Lifestyle inflation. Now, this part is different because not everything is caused by inflation. Sometimes we get in our own way. Let's say you start making more money. Naturally, you want to enjoy it. Maybe you move into a nicer apartment. You upgrade your car. You start ordering food more often. You buy more expensive clothes. You take more trips. You get a few more subscriptions. None of these decisions seems crazy on its own. After all, you can afford it now, right? But here's what happens. Your income goes from $4,000 a month to $5,000. Then your lifestyle goes from costing $3,500 a month to $4,800. You just got a $1,000 increase, but you're only keeping $200 of it. Where did the other $800 go? Your new lifestyle. This is called lifestyle inflation, and it's one of the biggest reasons someone can earn more every year while never feeling wealthy. Because every time they earn more, they spend more. New income, new expenses, new payment, new standard of living, and eventually the person making $100,000 starts feeling just as broke as the person making $50,000. Why? Because wealth isn't measured by how expensive your life looks. It's measured by what you own and what you keep. Let me ask you something. If your income doubled tomorrow, would you become wealthy, or would your bills simply double too? That question can reveal a lot. Debt makes your raise. Belong to someone else. Now let's add debt. This is where things can get really difficult. Imagine you get a $500 raise every month. Amazing. Except you have a $300 car payment, credit card debt, student loan payments, maybe a personal loan, maybe buy now, pay later payments. Before you even think about building wealth, a large part of your income already belongs to somebody else. And high-interest debt is especially brutal because you're not just paying back what you borrowed. You're paying for the privilege of having borrowed it. Interest can quietly turn a small purchase into a much bigger one. So you might earn more money, but instead of investing that money, you're sending it to creditors. That's why a person earning $80,000 with heavy debt can feel poorer than someone earning $55,000 with no debt and lower expenses. Income matters, but what matters more is what happens to your income after you get it. The real number you should watch. Most people obsess over one number, their salary, $50,000, $75,000, $100,000, $150,000. But your salary doesn't tell the full story. A better question is, how much money are you actually keeping? And then, what are you doing with what you keep? Imagine two people. Person A earns $100,000 per year, but after taxes and spending, they save almost nothing. Person B earns $65,000, but they live below their means, avoid expensive debt, and consistently save and invest. Who is building more wealth? The answer might not be the person with the bigger salary, because income creates opportunity, but your financial habits determine what happens to that opportunity. A big income with big expenses can create nothing. A moderate income with a growing gap between earnings and spending can slowly build wealth. That gap is powerful, because that's where your emergency fund comes from. That's where investing comes from. That's where financial freedom begins. So how do you actually get ahead? Does this mean you should never enjoy your money? Of course not. The goal isn't to live miserably. The goal is to stop every raise from disappearing. The next time you make more money, try this. Before you upgrade your lifestyle, decide what happens to the extra income. Maybe 50% goes toward your future. Pay off high-interest debt. Build your emergency fund. Invest for retirement. Invest in assets. Then use the rest to improve your life. The exact percentages will depend on your situation, but the principle is simple. Give your raise a job before your lifestyle spends it for you. Because if you don't make a plan for extra money, extra spending will usually find it. And here's something interesting. You don't necessarily need to become rich overnight to start feeling financially stronger. Imagine having a few months of expenses saved. Imagine not panicking when your car breaks down. Imagine having investments slowly growing in the background. Imagine getting a raise and knowing part of it is making your future better. That's a very different feeling from making more money while watching it disappear every month. The bottom line. So are you really getting poorer even though you earn more? Maybe. But the answer isn't just your salary. It's the relationship between four things: your income, your cost of living, your debt, and the amount you keep and invest. Your salary can go up, but if your expenses go up faster, you're falling behind. Your salary can go up, but if inflation reduces what your money can buy, you may not feel richer. Your salary can go up, but if every raise creates new payments, you can stay stuck in the same place, and your salary can go up. But if you consistently keep more, invest more, and avoid lifestyle inflation, you can actually move forward. So the next time you get a raise, don't just ask, how much more am I making? Ask, how much more am I keeping? Because making more money is good, but making sure more of that money actually improves your future, that's how you get ahead. And now I want to hear from you. Do you feel like you're earning more but affording less than you could a few years ago? Tell me what's gotten more expensive for you in the comments. And if you enjoy simple videos that explain money, business, and the economy without complicated jargon, subscribe. Because understanding how money works could be one of the most valuable things you ever learn. I'll see you in the next one.